The dealer who financed my last car made more money off my loan than he made off the car itself. I didn't find out for 2 years. Most people never find out at all. The number one thing standing between you and a fair car deal is not the sticker price, not the trade-in, not the interest rate. It is a single question you don't know to ask before you sign. I'm going to show you exactly what that question is and everything that changes when you ask it. I walked into a dealership 3 years ago thinking I had done my homework. I had a credit score of 741. I knew the invoice price of the car. I had printed out 3 competitor quotes. I sat down in that finance office feeling like I was ready. The F&I manager, finance and insurance, they call it, slid a contract across the desk with a 7.4% interest rate on a $38,000 loan over 72 months. He said it confidently, said the bank came back with that number based on my profile. I nodded. I signed. I drove home. 6 weeks later, I refinanced through my credit union and got 5.1% on the same loan. The difference over 72 months was just over $3,400. That money went to the dealership, not the bank. The dealership. I had never heard the words dealer reserve in my life. That is what this is about. Quick word before I go further. The old methods my family uses, there is more of it than fits in any one video. I gathered the whole of it into a book you can buy in our pinned comment below. The book is the long version. If you want it, it is there. I will not mention it again. Here is what happened in that finance office that I did not understand at the time. The lender, Chase, Capital One, whoever, had already approved me at a buy rate. That is the actual rate the bank determined I qualified for, based on my credit file. My buy rate that day was somewhere around 5.1%. The dealer is allowed by law to mark that rate up, usually 1 to 3 percentage points. He marked mine up 2.3 points, presented me with 7.4% as if it were a fact, and pocketed the difference as what the industry calls dealer reserve. It is legal. The CFPB has investigated it. There have been class action settlements over it. It is still happening in every dealership in the country today, and it will happen to you if you walk in without a competing number in your hand. That is the whole game. Everything else in that finance office, the extended warranty, the paint protection, the gap insurance, the tire and wheel package, that is all a separate game. But the rate markup is the one that costs people the most money with the least visibility, because you never see the buy rate. The contract just shows the number you agreed to. You assume the bank set that number? They did not. They set the floor, the dealer set the ceiling. So before you ever discuss a monthly payment, before you ever say yes to an interest rate, before you let them run your credit, you need a number from somewhere else. That is the only thing that changes the dynamic. Here is how to get that number and why most people skip this step and pay for it for 5 years. The step is called pre-approval. You go to your credit union, or a bank, or Capital One Auto Navigator, or Lightstream before you go to the dealership. You apply for a car loan. They pull your credit and come back with a rate and a dollar amount. That process takes about 15 minutes online. It does not require you to know which car you want. It does not lock you into buying anything. It is simply a number on a piece of paper that says, this institution will lend you up to $45,000 at 5.2% for 60 months. You print that page. You put it in your pocket. You walk into the dealership. Now the dynamic is completely different. The dealer can try to beat your pre-approval rate. If he does, take his deal. If he can't, you use yours. Either way you win, because now there's a floor and he can't go below it. He no longer controls the ceiling. Credit unions are the first place to look. They are member-owned nonprofits. They do not have shareholders to feed. Their rates on auto loans run consistently 1 to 2% below what banks and dealers offer. The national dealer average right now is 6 to 8% APR depending on term and credit. Credit unions are sitting at 4.5 to 5.75 for good credit borrowers. On a $40,000 loan over 60 months, the difference between 5% and 7% is roughly $2,200 in total interest. That is not a rounding error. That is a weekend away with your family that the dealer gets instead of you. You don't need to be a member already. Most credit unions let you join for $5 and a checking account. Some are open to anyone in your state. Look up your state's credit union association, go to any of the members, apply online, get the number, then go shop. That one step, 15 minutes at home before you ever touch a car lot, is worth more than every other negotiating tactic combined. Now you are in the dealership. You have your pre-approval letter. You have already negotiated the out-the-door price of the vehicle as a separate conversation from the financing. That is step 2. Keep those conversations separated deliberately and explicitly. The moment you let a dealer combine them, what do you want your monthly payment to be? You have handed over control of the deal. Here is why. If you say $450 a month, the dealer can hit that number 50 different ways. He can extend the loan from 60 months to 84 months and add $4,000 in interest. He can raise the rate and stretch the term to offset it. He can roll negative equity from your trade-in into the new loan without you noticing. All of these hit your 450. None of them are the same deal. The only numbers that matter are the total vehicle price, the interest rate, and the loan term in months. Get those 3 numbers separated and locked before you ever discuss payment. When the salesperson asks what you want to pay monthly, say, "I'm focused on the total price right now. We can talk about financing once we agree on that." The price is the price. Once that is on paper, then you walk into the finance office. And that is where the second game starts. The finance office has one job. It is not processing your paperwork. It is selling you additional products. That is where the dealership's back-end profit comes from. The F&I manager is the highest paid person in the building. He is trained specifically to sell you things in the 15 minutes you are sitting in that chair, feeling tired and relieved and ready to be done. The products he will offer you, in rough order of how often he presents them, are an extended warranty, also called a vehicle service contract, gap insurance, paint and fabric protection, tire and wheel coverage, and sometimes credit life insurance. There are variations. There are bundles. But those 5 are the core menu. Here is the honest framework for each one. The extended warranty, the markup on dealer-sold service contracts, runs between 50 and 200% over what the identical coverage costs if you buy it direct. The same underwriter, the same claim adjusters, often the same contract language. Bought through a dealer finance office, it costs $3,500. Bought through Endurance, Autopalm, or your credit union within 30 days of purchase, it costs $1,400 to $2,000. If you want an extended warranty, and on a used vehicle with high miles, you might have a real reason to want one. Tell the F&I manager you'll think about it and buy it direct within the window. That window is almost always 30 days post-purchase, sometimes 60. The F&I manager will tell you the offer expires today. That is not true. Walk out. Buy it later for half the price. GAP Insurance. This one has a genuine use case, which is why it gets sold so aggressively. It sounds reasonable, and sometimes it is. GAP covers the difference between what your insurance pays out if the car is totaled and what you still owe on the loan. If you put less than 20% down, have a loan term longer than 48 months, or rolled negative equity from a previous vehicle, GAP is worth having. But the dealer charges $700 to $1,200 for it. Your credit union offers the same product for $200 to $400. Before you buy it from the dealer, check 2 things. Does your auto insurance policy already include GAP coverage? Some comprehensive policies do. And did your lease contract include it automatically? If neither applies and you need it, buy it from your credit union at the time of your pre-approval. Done. Do not pay $900 at the dealer for something you can get for $250 at the credit union on the same day you get your pre-approval letter. The paint protection package. This costs $600 to $900 in the finance office. It is a spray-on sealant applied by someone in the service bay. A reputable detailing shop applies ceramic coating, a significantly better product, for $150 to $400. Modern factory paint on any car made in the last decade does not require an additional protective coating to survive normal conditions. This product exists to generate profit. Decline it. Tire and wheel protection, $800 to $1,500. Covers road hazard damage. Most comprehensive auto insurance policies already cover tire damage in certain situations. Check yours before buying. If yours doesn't and you park in a city with a lot of potholes, it might be worth pricing out, but not at the dealer's number. Nitrogen tire fill, separately offered sometimes, $100 to $200, is also a pass. Air is already 78% nitrogen. Your tires do not need the upgrade. VIN etching, $200 to $400. A stencil and acid solution applied to your windows. No measurable theft deterrence. Decline it. The question to ask when you're being presented with any of these products: can I buy this same coverage from a third party after I leave today? The answer is almost always yes. Then ask yourself if the price difference is worth paying right now to save 15 minutes. Most of the time, it is not. There is one more thing they will try before you leave, and it is the most effective trick in the building, which is why they save it for when you are exhausted and the keys are already in your hand. They will present the contract with the payment shown monthly and the add-ons buried in line items. The extended warranty is $47 per month extra. Gap is $14 per month extra. The paint protection is $18 per month extra. None of those numbers sound threatening. Together, they are $79 per month over 72 months, and you have just bought $5,688 worth of products that cost the dealer a combined $900. That technique has a name in the industry. They call it payment packing. The defense is simple and takes 3 seconds. You say, "Show me the itemized out-the-door total, not the monthly breakdown. Every single item, separated, with its full cost." Then you look at each line individually and decide if you want it at that price. That is all. Just ask for the itemized total. Most people never do. Most people stare at the monthly number, which was specifically designed to look manageable, and say yes. The bigger picture is this: the average car buyer in the United States overpays on financing and back-end products by between $2,000 and $5,000 per transaction. That is the range you are walking into every time you sit in a finance office unprepared. It is not an accident. The system was built specifically to extract that money in conditions: time pressure, paperwork fatigue, excitement about the car, social awkwardness about saying no to a person sitting across a desk, where most people's decision-making is at its weakest. The fix is not complicated. You are not outnumbered. You just need to walk in with 3 things: a pre-approval letter from your credit union with a specific rate in writing, a commitment to separate the vehicle price conversation from the financing conversation, and the habit of asking for the itemized total instead of looking at the monthly payment. Buyers who do those 3 things consistently save $1,000 to $3,500 over the life of the loan compared to buyers who go in cold. That is not hypothetical. That is what refinance data shows when people discover the buy rate 2 years later and do the math. Tonight, before you do anything else, pull your credit report for free at annualcreditreport.com. Know your score, then look up the credit unions in your state and check their current auto loan rates on their websites. Write the number down. That is your baseline. Everything a dealer quotes you above that number is margin you are giving them for no reason. If you are getting ready to buy, get pre-approved this week. 15 minutes. The letter costs you nothing and changes every conversation you have at the dealership. Tell me in the comments what state you're in and what rate you're seeing from credit unions right now. I read all of them. A lot of people find their best lead from someone else's comment. Next time I'm going to walk through how to negotiate the trade-in, which is its own separate game from the vehicle price and the financing, and the reason the dealer always wants to talk about all 3 at once. There is a specific order to do them in that shifts several $1,000s in your direction, and almost no one knows it.